If you're a Canadian who owns your home and also has a rental property, there's a good chance you're missing out on a powerful and completely legitimate tax strategy. This isn't about finding new investments or taking on more risk. It's about intelligently restructuring the money that's already moving through your accounts. Let's walk through how it works. The whole concept really boils down to this one simple distinction in Canadian tax law. The interest you pay on your personal mortgage, you get no tax break for that. But the interest on a loan you use to earn income, like from a rental property, that is tax deductible. So the goal here is to strategically convert that non-deductible debt into deductible debt. So here's our roadmap for this explainer. We'll start with the tax problems so many homeowners face, then we'll introduce cash damming, get into the step-by-step mechanics, and look at the real financial impact over time. And we'll finish up with what you absolutely need to have in place to do this right, and a final thought on how this can change your relationship with debt. Okay, let's dig into the core issue. If you're a Canadian homeowner, you know that a huge chunk of your monthly payment goes toward mortgage interest. And you also know that unfortunately, none of that helps you out come tax time. And this is a massive number. According to Statistics Canada, we're talking about tens of billions of dollars every single year that Canadians pay in mortgage interest, with zero tax relief. For most of us, it's just something we accept as a non-negotiable cost of owning a home. So, what can you do if you have a rental property? Well, there's a well-established strategy called cash damming. And I want to be really clear about this. This is not some kind of sketchy loophole. It's a structural approach to cash flow that works entirely within existing CRA rules. So, what is it, really? In simple terms, it's a way of reorganizing your finances. You're rerouting your cash flows so that you can convert your personal mortgage debt into debt that the Canada Revenue Agency sees as having an investment purpose. The whole thing hinges on setting it up and maintaining it correctly, but it's fully compliant. This is the rule that makes everything possible. It's a foundational principle of our tax system. If you can clearly prove, and I mean trace the money directly, that you borrowed funds to earn income, the interest on those funds is a legitimate deduction. Cash damming is all about creating that clean, undeniable paper trail. All right, so let's get into the actual mechanics. Now, I know this can sound a little complicated at first, but it's really just a disciplined way of redirecting money that you already have coming in and going out. Let's use a quick example. Imagine your tenant pays you $2,500 in rent. Normally, you might use that money to pay the expenses on the rental, but with cash damming, you do this instead. Step 1, you take that entire $2,500 and you put it directly onto your personal home mortgage. Step 2, because you have a special kind of mortgage called a readvanceable one, that payment instantly makes that same amount of credit available in your home equity line of credit, or HELOC. You then borrow that exact same $2,500 from your HELOC. And step 3, use that money from the HELOC to pay all your rental property expenses. That's it. You just repeat that cycle every month. So why on earth does this simple shuffle work? Well, it all comes down to one word: traceability. Because you are now borrowing from your HELOC for the clear, documented purpose of paying rental expenses, the CRA sees that borrowed money as an investment loan. Suddenly, the interest you pay on that HELOC balance is directly tied to an income-generating asset, and that makes it tax-deductible. And this isn't just theory or creative accounting. Over time, this strategy builds into very real, tangible financial returns. Let's put some conservative numbers on this. Say you redirect $30,000 of rental income over a year. At a 5% interest rate on your HELOC, you'd pay about $1,500 in interest. Well, if you're in a 43% marginal tax bracket, that creates a tax refund of $645 just in the first year. But here's where it gets really interesting. This benefit compounds. As you continue this process, your deductible loan balance grows, which means your annual tax refund grows right along with it. As you can see, over 10 years, that can add up to more than $35,000 in tax savings. Now, the smartest move is what you do with that refund each year. If you take it and apply it as a lump sum payment against your non-deductible home mortgage, you create this incredibly powerful virtuous cycle. You pay your home off faster, which saves you a fortune in mortgage interest, and you can potentially shave years off your amortization. Okay, so if this is starting to sound compelling, it's crucial to understand this isn't something to be taken lightly. You have to set this up correctly for it to be both effective and, most importantly, compliant. There are a few absolute must-haves. First, you need that readvanceable mortgage we talked about. Obviously, you need a rental property and taxable income to deduct against, but honestly, the last 2 points are the most critical. You need separate bank accounts to avoid mixing funds, and your bookkeeping has to be perfect. That clean paper trail is your proof if the CRA ever asks. And that really is the key. Success with cash damming doesn't come from pushing the boundaries of tax rules. It comes from being precise, disciplined, and having perfect documentation. It's about neatly aligning your financial structure with the existing CRA framework. When you really step back from the mechanics, putting a strategy like this in place represents a pretty fundamental shift in how you think about the financial tools you already have, especially your mortgage. Ultimately, cash damming doesn't increase your overall debt load. All it does is restructure it. It converts inefficient, non-deductible debt into efficient, tax-deductible debt. The goal isn't to take on more debt, it's to be more intentional with the debt you already carry. And that can transform your mortgage from a simple liability into a strategic part of your entire financial plan.